I don't know what you'd call the 40-year highs that we saw in inflation. Are those factors dissipating, staying about where they are, or increasing for the next 12 months?
At least on the physical goods side, they're likely to move higher. And the reason why they're likely to move higher is, again, I'm going to say it one more time, the world's second largest economy, the largest commodity consumer in the world, was basically hibernating over the last 12 months and has made it clear to the world it's coming out of the hibernation. Through addressing the zero COVID policy, but also through dealing with the property market. So these are very large developments, and you're seeing it starting to be priced into the dollar.
Does that merely keep us where we are because of the possibility the labor market opens up, or people come back to work, or mortgage rates at 7% cause rent prices to come down eventually as well? So shelter inflation isn't there. Do you see what I'm saying? How much do physical goods add to the entire inflation picture that got us to 40-year highs?
Oh, it was a lot at the beginning. I mean, they're relatively small. They're into that, right, 30-40% of the overall index. I mean, shelter alone is 40. So they're relatively small. I think that the message here that we need to be thinking about from a macro perspective is, what does a commodity run up in 2023 do to overall real incomes? Because it has to be a real price or relative price move, in the sense that before you had expanding money supply in tight commodity markets, so everything rose. This time around, money supply is shrinking. You even have tighter commodity markets, given what's likely to happen in China. That means a rise in commodity prices has got to come out of something else in the overall consumption basket. And that's why we put out a piece last week titled, "The Old Economy Takes Its Revenge." And what happened was the rise in, oil, food, capital goods, physical good commodity prices is starting to take a toll on discretionary spending in other sectors, particularly tech, advertising dollars. And as a result, new economy goes down, old economy goes up. And I think that's going to be a theme in 2023 and clear into 2024.
Talk just specifically about energy. Is Europe in a better position? People have said they've been able to prepare a little better for the coming winter in terms of natural gas. What do you think? What do you think oil? What's the high and low over the next 6 months for crude?
Well, I think Europe, the saying we said, you never get hit by a train you see coming. They made the preparations, they dealt with it, but they haven't dealt with the problem next summer and the following winter. So there's still a structural problem out there that they need to deal with. But the very immediate term, barring a really cold winter, they've got through it. And our view was prices were going to trade below 100 euros a megawatt hour. And we did see that briefly. Actually, even on an hourly basis, went negative because there was so much LNG packed into the European market during that time period. But I think the key message is we're not out of the woods yet on a medium or longer term basis. And oil is the one I would be focused on in December, when the EU import ban on Russian oil goes into effect. Russia's made it clear they want to retaliate. That risk starts to run relatively high. You lose the SPR barrels. You have disappointing shale production at this point right now. You have the demand in China rebounding. You put it all together, it starts to get very bullish at the end of this year and early next year, which is why we stick to our $115 target on Brent.
So everything you described are out of the Fed's ability to control.
Absolutely. By the way, when we called for a commodity super cycle, it's not that we just think prices are going to trend up over time. It's you get spikes. Each spike, the high is higher than the previous one. Right. The low is higher than the previous low. And you just do that over the course of several years. And we're in the process of the backside of one of those spikes left over from the summer. And as we go into the winter months, we're likely to see another spike. And you're already seeing the evidence of it in diesel and in heating oil product prices.